Most people think they just watched silver crash. They think the move from above $90 back into the mid-70s was the end. Another bubble. Another failed breakout. Another reminder that silver always disappoints. But while analysts were calling the top, while retail investors were panic selling, someone else was buying. Not cautiously. Not emotionally. Not in small lots. They were absorbing size. Strategic size. And the data trail they left behind tells a very different story about what is happening right now. Before we go deeper, I'll say something quickly. This channel is built for people who prefer signal over noise. These videos take real research, real time, real effort to build properly. If you appreciate economic analysis without hype and without emotional predictions disguised as certainty, consider subscribing. It helps more than you think, and it allows us to keep producing this level of work consistently. Now let's get back to the market. Because what we are watching in silver may not be a price spike. It may be the early phase of a structural repricing event. And if that sounds dramatic, stay with me, because this is not built on emotion. It is built on pattern repetition, supply mathematics, and strategic behavior from players who do not trade headlines. Silver crossing $50 in early 2025 was not just another breakout. That level had capped price action for nearly 50 years. In 1980 silver touched $50 and collapsed. In 2011 it reached $49 and collapsed again. For decades, the market treated $50 as a natural ceiling, almost like a law of physics. Gold moved beyond its 1980 high of $850 and later traded above $2,000. Copper broke its historical range near $1.50 per pound and surged above $4.50 in 2006. Oil broke its long-term range in the early 2000s and never returned to its previous structural floor. Every major commodity that spent decades compressing eventually broke higher and permanently repriced. Silver was the only one that did not. Until now. Between 1980 and 2024 silver was essentially trapped between $4 and $50. That is not normal behavior for a monetary metal and industrial input simultaneously. That is compression. And in markets, compression is stored energy. The longer it lasts, the more violent the expansion when it finally breaks. This is not theory. It is observable across commodity cycles over the last half-century. But a breakout alone does not matter. What matters is the structure that follows the breakout. And that structure has appeared only twice in modern history, once in 1979 and once again in 2010 into 2011. Both times the sequence was remarkably precise. In early 1979 silver was around $12 per ounce. By March it moved to $18. By August it reached $25. The acceleration phase lasted roughly 2 to 3 months. Then came September. Price went vertical from $25 to $35 in 3 weeks. Then came the correction. A sharp 9-day pullback from $35 back to $30, roughly a 14% retracement in just over a week. The media declared the rally over. Investors exited. And then the final surge began. From $30 to $50 in roughly 2 months. 40% gains in 60 days. Total cycle length from acceleration to peak, about 5 months. Now fast forward to 2010. Silver was trading near $18 in August. By September it was $22. By December it was $28. January 2011 delivered the acceleration, from $28 to $38 in about 4 weeks. Then came the correction. 11 days. From $38 back to $32, roughly a 16% drop. Headlines again called the top. Retail again sold. And then silver surged from $32 to $49 in 8 weeks, a 53% move. Total cycle duration, roughly 7 months. 2 different decades. 2 different macro environments. One during high inflation fears and the Hunt brothers episode, the other during post-2008 quantitative easing. And yet the internal structure was nearly identical. 2 to 3 months of acceleration. A violent mid-cycle correction of roughly 15 to 25% lasting around 1 to 2 weeks. Then the majority of gains occurring after the correction, not before it. Now look at where we are. November 2025 silver begins accelerating from around $70. December it climbs toward $85. Late January 2026 it surges above $90. Then in a brutal 36-hour window, it collapses back towards $75. An 18% drawdown almost instantly. Social media fills with regret. Analysts call it a blow-off top. Silver bubble bursts, becomes the narrative. But structurally, that is month 3. That is the exact location where both prior cycles delivered their shakeout correction. The magnitude lines up. The speed lines up. Even the psychology lines up. Panic in the middle, not at the end. If this template holds, and we must stress if because markets are probabilities not certainties, then historically 60 to 70% of total gains occurred after this correction phase. Not before it. After it. And this is where things move from technical curiosity into fundamental gravity. Global silver mine production in 2024 was approximately 840 million ounces. Industrial demand alone was around 550 million ounces. That industrial demand is projected to exceed 700 million ounces by 2027, driven largely by solar panels, electric vehicles, electronics, medical applications, and 5G infrastructure. Each solar panel requires roughly 20 grams of silver. Global installation targets over the next 3 years require billions of panels. That alone adds an estimated 150 to 180 million ounces of annual demand growth. Electric vehicles use between 25 and 50 grams per vehicle in electrical contacts and systems. With EV production projected to triple between 2024 and 2027, that represents another estimated 60 million ounces of incremental demand annually. Meanwhile, about 70% of silver is produced as a byproduct of copper, zinc, lead, and gold mining. If base metal production slows, silver output does not respond independently. Ore grades have declined by roughly 15% over the past decade. It takes 7 to 10 years to bring a new mine from discovery to production. Supply cannot respond quickly. Exchange inventories have already declined significantly since 2022. Vault holdings have trended lower. Refiners have reported sourcing delays. The market has been running in a supply deficit for multiple consecutive years, and some projections estimate potential annual deficits exceeding 200 million ounces by 2027 if demand growth continues at current pace. That is not a small imbalance. That is structural. Now layer behavioral evidence on top of this. During the late January crash, exchange data showed significant block transactions occurring at very specific price levels, around $78, $75, and $72. These were not scattered retail trades. They were coordinated, size-based absorptions. When fear spikes and large players step in with precision buying, that is not emotional participation. That is strategic positioning. Certain governments have quietly reclassified silver as a strategic resource alongside lithium, cobalt, and rare earth elements. When a metal shifts from being viewed purely as an investment commodity to being considered critical infrastructure material, behavior changes. Nation-states do not wait for shortages to become obvious. They accumulate before supply becomes constrained. This is not conspiracy. It is pattern recognition across commodity markets. China did this with rare earths. The United States has done it with lithium and cobalt. When supply security becomes a concern, Price becomes secondary to availability. Now none of this guarantees $300 silver. We need to stay grounded. There are real failure scenarios. A major liquidity crisis could force broad commodity liquidation. In March 2020, even gold dropped 20% in 2 weeks during margin stress. Silver fell harder. If a systemic financial shock occurs, this cycle could be delayed or temporarily invalidated. Policy intervention is another risk. Futures exchanges can raise margin requirements. Position limits can be tightened. Strategic reserves can be released. Coordinated derivatives pressure has historical precedent, such as the London gold pool in the 1960s. Demand projections could also disappoint. If solar subsidies decline or EV adoption slows, growth could underperform estimates. Manufacturers could reduce silver content if prices spike too rapidly, similar to palladium substitution in the early 2000s. And finally, patterns do not have to repeat. 2 prior cycles do not create a law of nature. They create a probability structure. So the rational approach is not all-in speculation. It is asymmetric positioning. For industrial users, partial hedging protects against supply shock without overcommitting. For long-term capital allocators, exposure should be meaningful but not catastrophic if wrong. The critical point is this. When a commodity breaks a 50-year ceiling, it rarely returns to the old regime. Gold did not. Copper did not. Oil did not. If silver's breakout above $50 in 2025 represents a genuine structural shift rather than a temporary spike, then the repricing may not be incremental. It may be nonlinear. If we are indeed in month 3 of a 5 to 7 month expansion cycle, and if the historical template holds, then the period between now and mid-summer 2026 becomes statistically the most aggressive phase of the move. A doubling from mid-70s levels places silver above $150. A more extended acceleration, similar in scale to prior percentage expansions, pushes into the $200 to $300 range. That does not make $300 inevitable. It makes it mathematically plausible within the historical volatility structure silver has demonstrated twice before during breakout regimes. And here is the deeper shift. This may not be about speculation at all. It may be about transition. Transition from a suppressed, range-bound metal into a strategic industrial input competing in a supply-constrained world. If that transition is underway, price is simply the adjustment mechanism. The real question for anyone watching this is not, will it hit $300? The real question is, what is the cost of dismissing the possibility entirely? If it fails, controlled positioning limits downside. If it succeeds, ignoring it could mean missing one of the most asymmetric commodity repricings in decades. Markets do not care about opinions. They respond to supply, demand, capital flows, and behavior. The pattern is visible. The deficit is measurable. The accumulation is observable. Whether it completes or not will be decided by forces far larger than commentary. But one thing is clear. What is happening in silver right now does not resemble a random spike. It resembles the early phase of structural transformation. And transformations, once fully underway, rarely reverse quietly. The next 90 to 120 days will provide clarity. Either the template breaks and this becomes another failed breakout, or the final acceleration phase begins and rewrites the pricing regime that has defined silver for half a century. The market will decide. It always does. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.